Good afternoon. This is Robert Sinn, presentation for the September 2024 Metals Investor Forum. The title is The Only Two Metals You Need, the Trends That Matter. So before we get started, obviously I'm not there in the flesh, a bit of a frustrating experience yesterday with air travel. Sometimes you have plans and the air travel gods laugh at you. But here I am, and no reason to be upset with gold at 26.47 and copper moving back up above its 200-day moving average. We're going to talk about both those metals today. So forward-looking statements, obviously, I will be talking about future outcomes and potentialities. Copper and gold, we're just getting started. So in January, at this very conference, I stood on the stage there in Vancouver and pounded the table on gold when it was 2025 an ounce. Copper was 375 a pound. Had a very bullish outlook for 2024 and 2025 for both metals. And here we are. Gold is up 30% since that day. Copper's up a lot more than 10%. At one point in the year, it was up more than 30%, but it kind of overshot back in May, and it's had a correction since. I'm going to talk about why I like both of these metals a lot. In fact, the two metals actually kind of complement each other right now. My message is to stay the course. It's uncomfortable sometimes to be an analyst, market commentator, and get up on stage and be bullish at all-time highs. There's always that thought in the back of my mind that, uh-oh, I'm going to be bullish at the top and I'm going to look like a fool. But the reality is the weight of the evidence is that gold has further room to run, and copper is at the beginning of a secular bull market. So the three big drivers for gold and why gold has already had such a big move in the last couple of years since the 2022 bottom at 1625, and why I believe it has further to run is central bank policy easing. The Fed cut 50 basis points with gold at all-time highs last week. I'll say that again. The Fed cut 50 basis points last week in September of an election year with the stock market at all-time highs, with gold at all-time highs, and the Fed chairman saying repeatedly the economy is strong and we're going to keep it that way. That's a big deal. That's a big deal. And there's an incongruency in his statement that the economy is strong and is going to stay strong while cutting 50 basis points in September of an election year. The European Central Bank is cutting. The Bank of Canada is cutting. Many central banks around the world are cutting. In fact, more than 50 central banks around the world are cutting interest rates and easing policy this year, and they will continue to do so next year. Emerging market central bank buying, so whether it's China, Russia, Turkey, or India, central banks are buying gold. The de-dollarization flows are real and they're strong and they're getting stronger. Western investors are beginning to buy gold ETFs. So this is the third piece of the puzzle. This is the third leg of the stool that we've been waiting for. It didn't appear in 2023, but it's starting to appear in 2024, and the trend is strengthening. So the North American investors are beginning to buy the gold ETFs. And with a Fed easing cycle likely to continue for some time, these trends are likely to only get stronger. So the Western investors, the North American investors are likely to continue to pile in to gold ETFs. So that's a very powerful key underpinning of a gold bull market cycle. So the trends that matter: lower real rates, lower interest rates. Simply, real rates have been very positive for 2 years now, and the Fed is realizing that it's been weighing on the economy, and the employment market has rebalanced from too loose to being, or from too tight to being too loose now. Quite frankly, there's a lot of evidence that the labor market is loosening further and likely to get weaker over the coming months and into early 2025. We know about the debt. During the last 5 years, the U.S. has run record budget deficits under Trump, under Biden, and whoever is the next president, that is likely to continue. This was record deficit spending and piling up of government debt during a time of supposedly strong economic activity. We've never seen this before, and I believe that is one of the key reasons why gold moved so far ahead of this first rate cut from the Fed. There's a few reasons why gold jumped from 1600 to 2,500 over the last couple of years. But this is definitely one of them. The fact that the deficits were bigger than ever during a time with 3.6% on the unemployment rate begs the question, what happens when unemployment is 6%? CPI inflation is falling. So the reason why the Fed tightened so much, got the Fed funds up to 5.5%, was the inflation overshoot to the upside in 2021, 2022, and 2023. Well, we're now at risk of undershooting. 3-month rate of core CPI is 2.1%. There's evidence that it could go below 2% over the coming months. The undershooting risk is real. Powell sees it. That's why he cut 50 basis points in September of an election year with the stock market at all-time highs. Also, China is exporting deflation. Just quite frankly, whatever is going on in China, the property bear market there, the bursting of a bubble, they are exporting deflation. We're seeing it in oil. We've seen it in copper during the summer. We're seeing it in a lot of other commodities. China is exporting deflation. Powell sees it. He's got to try to counteract it before he has a too low inflation problem on its hand, right? And de-dollarization flows. So this is continuing to strengthen. This is continuing to pick up speed. And in fact, gold just took over the number 2 spot in global reserves ahead of the euro currency. Weaker dollar, we know when the Fed lowers interest rates, lowers the price of money, potential for quantitative easing again down the road, the dollar weakens. And just the fiat currencies globally, so whether it's the euro, the yen, the pound, the dollar, it doesn't matter. They're all weakening. They're all in a race to zero over time, becoming worth less over time. And gold, the tried and true store of value, the timeless counterparty truth, gold is truth, becomes more valuable when priced in those fiat currencies that become worth less over time. Gold has emerged as the number 2 reserve currency. We talked about that. And the labor market rebalancing. So from too tight to too loose. We're too loose now, and we're going to get looser. The JOLTS data, the trend in the JOLTS data, the trend in the non-farm payrolls data, the revisions downward 12 of the last 17 months, it all paints a picture of Fed is too tight, needs to cut a lot more to support the labor market. And we're seeing it in the data, the soft data, the hard data, the prices of airline tickets, hotel vacancies are increasing, cruise lines, lower bookings. It's all there. So here's the chart. Maybe just look at this chart. You don't need to hear the rest of my presentation. All the slides I have. This cup and handle breakout is incredibly powerful. It's more than a decade in the making. It's probably one of the most important chart patterns out there today, maybe even in history, because of what this means and what this could mean about what's to come. But this is clearly a breakout. And you don't need to be a technician to say, wow, that is impressive, and it looks like it's going higher. Whether that means it's going another $50 higher, $100 higher, $500 higher, $1,000 higher, I don't know. But simply put, we're not there yet, in my opinion. And the simplest way to play this is to stick with the trend until there is strong evidence that the trend is broken. I don't see any evidence that this trend is broken yet. This is what I was talking about, airline, cruise lines, accommodations, all in decline, downtrending, signs that the economy took a real turn lower earlier in 2024, and that is continuing. So Powell cut 50 basis points in September of an election year. I'm going to say that again. And he called it an appropriate recalibration. He used the word recalibration over and over again. Basically, that's admitting that rates were too high. He's got to get it closer to the neutral rate. He also said the U.S. economy is in a good place and we intend to keep it there. But look at the last several times that the Fed cut 50 basis points. Well, the years were 2001, 2007, 2008, and 2020. What happened during those years? Recessions every single time, market turmoil every single time. Is this time going to be different? I'll let you figure that out. We do not seek or welcome further cooling in labor market conditions. This was the Jackson Hole speech in August. Well, look at Philly Fed non-manufacturing employment, full-time, recessionary. The last time it was this low was the pandemic. It is lower than it has been for more than a decade, and it's trending lower. This often leads non-farm payrolls. We've seen all the revisions in payrolls. We've seen the trend in jolts. We've seen the fact that job openings have dropped basically in half in the last year, and they are continuing to trend lower. So the jolts implied net job growth is on its way down towards maybe even zero by the second half of 2025. Again, the trends that matter, the trends in the employment data lend favor to more rate cuts and probably even another 50 basis point rate cut in November, 2 days after the election. Again, here's the non-farm payrolls data. Look at the yellow line. That is a trend. It is lower, and the weight of the evidence says it's going even lower over the coming months. And what about all this, record employment, this really low unemployment rate in 2023? How good the economy was. Everybody was doing well. The Biden, administration kept telling us how great everything is. Well, the revisions downward, 12 of the last 17 months for a total of over 600,000 payrolls, tells a different story. And when you really dig down into the data, into the details of the data, and who has been getting these jobs in the last couple of years, and part-time, full-time, second jobs, what's the pay? It's not that great. It's not this rosy picture that they've wanted us to, think is real. Okay, it's just not real. And this is actually more like the real data, and it's just been kind of stagnating for the last year or so. It's not been a growing labor market. It's not been an expanding one. It's been a stagnating one. The revision. So we're negative. This is the 12-month average, negative 30,000 per month. And the last few times that we were at this level, recession was either we were in it or it was around the corner. So the weight of the evidence continues to spell out that the labor market is not as strong as portrayed, and in fact, it is weak and weakening. Big companies, multiple rounds of layoffs, right? So whether it's Amazon, Goldman Sachs, Tesla, big companies laying off thousands of employees in multiple rounds. And the Beige Book, the Fed Beige Book, is one of the best, real-time looks into the economy that we get. And the September one that came out a couple weeks ago, the nationwide outlook said employers were more selective with their hiring and less likely to expand their workforces, citing an uncertain economic outlook. Well, I don't think that uncertainty is going to change with the election, 6 weeks away, and then who knows what happens after that. I think the rest of 2024 is likely to remain uncertain, and hiring is likely to continue to decline over the next few months. Well, then we'll see what 2025 brings, depending upon who the next president is. But certainly, it seems like uncertainty is here to stay. Consumer income expectations. So this is a big one because when people feel good about the outlook for their incomes, they spend more, they're more confident, they're more likely to take trips. Like, remember the airfares, the airline travel and cruise lines chart that I saw earlier. Well, look at this. People are seeing their income outlook either stagnating or only rising modestly 1 to 2 years from now. And that's a big change from just last year when they saw it rising almost 3%, right? And services inflation was one of the big components of the inflation burst that we saw in 2021 through 2023. Well, that is now moderating and likely to moderate further. Meanwhile, credit card debt is at a record high, savings rate is at a record low. So your savings rate is low, credit card debt is high, your income is no longer growing, and you have less job opportunities. How are you feeling about the economy now? This is why Powell cut 50 basis points in September of an election year. Another part of the inflation burst we saw in 2021 and 2022 was rents and the housing market having a boom. Well, that has reverted to the mean, and in fact, quite the opposite now. We're not rising 12%, we're barely rising 2%, and actually there's cities, multiple cities across the country where rents are stagnating or actually declining rents. So stop talking to me about CPI inflation. It is not the concern here. In fact, the opposite. Inflation is about to become too low, meaning the Fed has to do even more, which makes it even more bullish for gold and should also give a shot in the arm to other commodities as well. Affordability remains at record lows. Fed has to cut interest rates. Fed has to cut interest rates. Fed has to restart the housing market. Here's another clip showing rental market cooling, and landlords are giving concessions across the country, trying to stimulate new renters to come into their properties. So the second key trend, central bank buying. Recall in February 2022, the invasion of Ukraine caused sanctions to be put on Russia, and the world changed in basically 1 month. And what we saw was central banks, especially ones in the East, buying gold, hoarding gold, even as real interest rates went super positive throughout 2022 and 2023. Usually, very positive real interest rates are a major negative for gold. Well, 2022 and 2023 broke that correlation, broke that, and the divergence really got pronounced at the end of 2023 and into 2024. And this is central banks buying gold, not concerned about real interest rates, and also a big segment of the market betting that the Fed was going to have to cut. They were too tight. Well, here we go. The Fed is cutting, and they're cutting aggressively. Central bank gold purchases. The reason why gold was $300, $350, $400 an ounce throughout the 90s and early 2000s was this central bank gold selling. Okay, so official selling of gold reserves that flipped in 2010, and it hasn't looked back. And in fact, it strengthened in 2022, 2023, and it's strengthening in 2024 as well. Central banks are buying gold, especially in the East, and that's a trend that is strengthening. Okay, it doesn't look like it's dropping back anytime soon. And unreported net gold purchases. So this is a big deal. This is almost a 3x jump from the average from 2010 to 2022 to just the last couple of years. Quarterly buying totals jumping big. Yield curve de-invert. So this is another feather in the cap of the recession camp, another feather in the cap of the Fed's going to have to cut a lot more over the next 6 to 12 months. The yield curve was inverted for more than 2 years, and it de-inverted in the last 2 weeks, and the yield curve has been steepening. This is a sign the Fed has to lower the short end of the yield curve. They have to lower interest rates a lot because the economy is weakening. Also, a steeper yield curve, a more normal yield curve is usually more bullish for commodities like copper. This is a chart I made last week, just showing the bull market cycles 2011 to 2011, 2007 to 2011, 2018 to 2020. Gold had huge moves during these two periods of time when the 10-year yield was declining by pretty large amounts, right? And coming off of a major top like 2007, major top like 2018, well, the 10-year yield is coming off a major top in at the end of 2023, early 2024, and it is going lower. U.S. budget deficit trends, we know this. This is a very strong trend and only likely to strengthen further. Gold. You want to own gold, not dollars. Gold is now the second largest reserve currency ahead of the euro. You can see the yellow has been widening out in the last couple of years, and the dollar, the gray, has been declining. Gold is taking up more space in central bank balance sheets and high net worth investor vaults. And the ETF buying. North American investors are getting into gold. Finally, they were net sellers throughout 2023, early 2024. Well, they just flipped in the last couple of months. We've just started to see the first ETF buying. This is a big deal. This is a big deal. This is the third leg in the stool, the key underpinning here of this bull market. North American investors are buying at all-time highs. Chinese investors are buying silver. Relatively small, notional dollar amounts here, but after a period of relative dormancy where Chinese investors weren't really interested in silver, now they want silver. I wonder why. So copper. I believe that gold and copper complement each other here a lot because in a hard landing outcome for the economy, gold will do very well. Gold miners will probably do extraordinarily well because their costs will fall, and the gold price will be going up, right? It's pretty simple. In a soft landing outcome, copper probably does better. And that's just pretty much self-explanatory. The economy is healthier, more copper consumption, more building, stronger housing market, et cetera, et cetera. So I believe that copper and gold complement each other here, and there are some outcomes where they can both do well at the same time. Obviously, China has been the big headwind for copper. China is the biggest player in the copper market. April, May, China was back. It seemed like everything was going back to normal. Maybe the worst was over for the Chinese economy, and then they turned sellers again at the end of May and June. It's hard to figure out what exactly is going on in China, quite frankly. But copper made a higher low just recently as the headlines from China appeared to get worse, right? The negative sentiment around the Chinese economy and the outlook for China got worse. Copper made a higher low. I think that's bullish. Also, as the Fed cuts interest rates, I believe that manufacturing activity in the US should stabilize. Manufacturing activity has been very weak the last couple of years. It's been weakening. I expect that to change as the Fed cuts interest rates. Not necessarily right now, but probably into next year. And the major underpinning for the copper bull market supply picture, the supply is just not there. Meanwhile, AI will compound copper consumption moving forward. The metal, the red metal, is a key ingredient in electrifying that the data centers that run the AI technology. 160,000 tons annually of copper consumption by 2026 for AI data centers, according to Goldman Sachs. And obviously, we know about the green economy and how much copper is needed in the green economy. Actually, 5 times more copper for solar, wind, and the new energy storage systems that are being built out there. So, just simply put, it's very hard to guess what copper consumption is going to be like out to 2050. But I think the simplest way to look at it is global population growth. So, we're at about 8 billion people on the globe right now. We'll probably be closer to 9 billion by 2035. So, let's call it 10% increase over the next 10 years. We're going to need a lot more copper. Copper consumption will surely be a lot higher in 2035. We'll look at the expected mine supply in 2035. It's actually falling, and 10 years is a relatively short time in the mining industry to find a new deposit, to get it to the feasibility stage, and then get it permitted. You're looking at usually more than 10 years. So if you find it today, it's probably not going to be in production by 2035. And there's certain projects like the Resolution project in Arizona or Pebble in Alaska, where it's been more like 20 years and it's still going. The clock is still ticking. Again, these forecasts are always fraught with error, but a million metric ton deficit in 2025, that's a big deal. If that proves to be true, copper price is probably going a lot higher. And look at what comes in 2026 and 2027, deficits as far as the eye can see. And even a more conservative forecast for 2025 and 2026 doesn't see as big deficits, but look at the deficits here from Scotia in 2028, a million metric tons. And what happens when copper sees a 1 million metric ton deficit on an annual basis. Well, we have 2004 as an example. Copper was up 40% in 2004, so that's possible. China, everybody's negative on China. The chart, obviously, it's gone down. China property stocks in a huge bear market. So we know what's happened. That's the rear view mirror. China has had a rough few years. What's next? I would have to bet on the Chinese central planners to take some very powerful action with China property stocks at the 2008 global financial crisis lows. Obviously, they have been doing some stimulus, but hasn't been big enough yet. Could a massive policy response be coming? That's probably going to be stimulative for commodities. And there are some signs the tide is turning. Shanghai copper, the inventories in Shanghai have been falling in the last couple of months, and the premia has been increasing for copper. So that's a positive sign, some green shoots. And look, we put in a higher low. Here's this, reversion back to the mean, to the test of 200-day moving average. The rising 200-day moving average made a higher low. Here's a low in October, here's a higher low in February, and here's a higher low in August. That's an uptrend. Obviously got way ahead of itself in May, but it reverted to the mean, it corrected, and we're moving back up again. I think that's bullish for copper. Turning to junior mining. Just from a sentiment standpoint, where do you think the junior mining sector is today? Is it copper juniors, gold juniors? You think we're in the euphoria stage right now? I don't think so. What about thrill? Are there people seeking thrills out there right now? I don't think so. I would guess we're probably closer to this hope or just before hope. I don't even think we're at optimism yet. Okay, that's how bad it's been and how early I believe we are in this junior mining cycle. Also, we know that commodities go in these big multi-decade cycles, right? We had a tremendous bull market cycle in commodities in the 70s, more than a 10-year bull market. We had a bear market in commodities in the 2010s. Well, it looks like we could be flipping back into a bull market. If that's the case, well, we're only a few years into this bull market, and these bull markets tend to go for 10 to 20 years. So I would say we're still very early here for copper. And looking at the sector, and the same goes for gold, everybody's been saying, why isn't there more M&A? Why isn't the seniors buying more of these juniors? And the answer is, well, their share prices haven't been high enough to do so, and they haven't felt good enough about their balance sheets. 2021, 2022, we saw those big cost jumps, those big cost inflation across the miners. They didn't feel like they could spend their balance sheets at that point in time. That has changed in 2024. It seems like the costs across the industry have stabilized now this year with what we're seeing in the oil price. Maybe even we could see some dropping cost per ounce here in Q3 and Q4 of 2024. That would be really positive for the sector. The companies are building up their balance sheets again. Cash balances are going up. Free cash flow is being generated with these gold and copper. Copper above $4 is great for copper miners. Gold above $2,500 an ounce is incredible. It's nirvana for gold miners. So the free cash flow is being generated. Share prices are up in 2024 quite a bit. So M&A is surely accelerating. We're seeing evidence of that here with some of these transactions, and certainly to accelerate further over the coming year. So the majors are going to start moving down the food chain, buying feasibility and permitting stage projects, and then maybe even moving into the earlier stage junior projects that may not even have a feasibility study. Just simply, why are they going to do that? Because they're not making any new discoveries, zero discoveries, right? So especially in copper, there's no new discoveries, not any major ones being made in the last couple of years. Now that could change very soon as companies spend more money on their exploration budgets and there's more M&A taking place. So what happens in a new discovery? Well, in the case of Arizona mining, in 3.5 years, you had a 25x rise in the share price, 25x in 3.5 years. This was a phenomenal outcome, extremely fortuitous event, but a new discovery. in Arizona, CRD discovery. And that's relevant for the companies on my panel today. Prisma Metals, Arizona, Copper Explorer, with also gold silver projects in Mexico. In fact, Prisma is about to drill its Palos Verdes project in Mexico, adjacent to Vizsla Silver. I think drilling is about to get started this weekend or maybe next week. I'll let the CEO tell you all about it. I was at the company's Hot Breccia project in the Arizona Copper Belt in August. This is a very exciting. I can't wait till they drill it. I cannot wait till they drill Hot Breccia. Very compelling drill target. Um, Porphyry skarn target, not too far from the Resolution deposit owned by Rio Tinto, whatever that is, 1.8 billion tons of 1.5% copper. Obviously, it's too early to say it's Resolution 2.0, but it is a good analog in terms of the target. You have a deeper porphyry skarn target with a lot of evidence at surface of this hydrothermal event that occurred a long time ago that brought some of those copper sulfides that we hope are concentrated at depth up to surface. There's in this hot breccia, that the namesake of the project, there are evidence of those copper sulfides grading 1% or greater. These little fractures that came up hundreds of meters from deep in the earth. So they need to drill it. They got some data recently from Bear Creek. I'll let them tell you all about it. Okay. And then Intrepid Metals, another Arizona copper export, copper and gold. I was at Intrepid's projects in Cochise County, Arizona in April. I'm super excited to see them drill that CRD target at Tombstone South. Hopefully we get, like an Arizona mining type of outcome there with that one. But also, just simply put, they have over 1,800 acres of private patented claims there in Cochise County. And they drilled some beautiful intercepts back in the spring, including 112.95 meters, grading 1.5% copper and about a half gram gold, and many more intercepts. And I think there's a lot of room for expansion there. It's sort of again, a porphyry skarn setting with a supergene, enrichment layer at surface. So a lot more potential there as well.